All right, guys, welcome back to the Keys to the Kingdom podcast. This is episode number 11. So today we're here with Sita. Say your last name for me.
Dumbuya.
Dumbuya. So you guys, my audience, this is Sita. If you want to find out about more about Sita, where can they contact you? Either like your
Uh,
social media or
yeah, I'm on Instagram, Sita underscore Dumbuya. On LinkedIn, Sita Dumbuya. It's just my name on all platforms.
great. All right, guys. So y'all make sure to tap in with him. So I'm gonna go ahead and get to the first question. So Sita, why did you get into real estate?
Yeah, so I got into real estate because my family's from Sierra Leone. I was born in Atlanta, born and raised in Atlanta. But wanted to get into commercial real estate because the first time that I remember us going back to Sierra Leone, like when I was in high school, just noticed there was a lack of development, and a lot of people that were developing they weren't Sierra Leoneans. So I want to understand the business and how to do real estate at scale, so that I could go and do development in Sierra Leone and eventually branch into other African countries and just do real estate globally. So that was the initial reason for getting into it.
Wow, that's a very expansive reason. You mind if we go into that a little bit?
Yeah, of course.
Yeah. So I did my DNA test. I'm from Sierra Leone.
Really?
Like, yeah. I think it's like 10%
Okay.
Sierra Leonean. So that's cool. So you said you went to Sierra Leone with your family in high school, right?
Yep.
So was that like junior year, sophomore year, senior, freshman?
Freshman year.
Okay, so freshman year, and so now you're seeing all of this development that's taking place in Sierra Leone. And by the way, how long was that trip?
We were there between 2 and 3 weeks. I think just under 3 weeks. It was
Wow.
around December. It was like we went for Christmas, New Year, stuff like that.
Okay. Wow. Yeah. Around New Year's. So that one trip for 3 weeks had an impact that you decided that you were going to make this your career and invest into real estate here, there, and then you said eventually in the rest of Africa.
Yeah.
Wow, that's astounding. I mean, that's great. I commend you for that. So what type of real estate did you see when you were over there?
It was more so the lack of it. Um, that I would say initially, even aside from particularly real estate, just development in general. Like I mean, of course they have paved roads, they have cities. Like it's not all like what you see on TV or in movies when they talk about Africa. Definitely was some industrialization, but there was still certain places, certain pockets where you didn't have even paved roads, or like it might be the main road is paved, but if you like branch off into the other roads to try and get in somebody's house, part of that may not be paved. So stuff like that where you didn't see the things that we're just used to here, where like everything is developed, most major cities, everything's gonna be developed. And the newer developments that we did see, because we did see some, they were by other people a lot of times, and a lot of businesses are ran by foreigners. Yeah, a lot of people that aren't Sierra Leonean that run a majority of the businesses, and when something like that happens, it's essentially like a lot of the wealth is being moved out of the Sierra Leonean community, like the native community, into the community of these foreigners, and they don't have the same attachment to the country or the people in Sierra Leone. So you see same thing that happens here where areas get gentrified, but we end up getting pushed out because we can't keep up with the gentrification, and we don't participate in it. We're not active collaborators in the development and progress of the community. It's the same thing that's happening in Sierra Leone. And as I've traveled to other African countries, the same thing is happening in other countries. Maybe not as severe, but you are seeing just a huge disparity in just the amount of business that is being ran by people that are from different areas and different cultures.
Well, that's certainly impactful. So you guys listening, there's always a reason why somebody gets into real estate, and I'll just say that your reason for doing anything is a lot more important than the thing itself. So, so now, Sita, how did you make your first purchase?
Very first deal was a duplex. Well, it was technically a house with a guest house, but the guest house is like 2 stories as big. Um, and got it off market. So I was networking. At first, initially, I was in wholesaling and didn't really have any luck with that. Didn't I wasn't in it for very long. I didn't really want to do it, but that's kind of where to tell a lot of beginner people in real estate, oh, you can go in, you can make $50,000 by selling the contract to somebody else, and you don't have to have any money. It kind of sell you on that. So I started in it, but then moved into like I want to do commercial, I want to do large scale commercial, and started learning about multifamily syndication. And then like somebody suggested that the best way to start off in multifamily syndication is to start with a small multifamily, fix it up, and then you essentially learn the process that scales into large multifamily where you're buying apartment complexes and you're improving them, increasing the value, and then selling it at some point. So I got into the first duplex by just trying to go through that route, figuring out, learn it, and then be able to scale. And I ended up connecting with an agent. He was by my age. And one of the reasons I picked him as an agent is because he was already working on large multifamily projects through syndication. And he was my age. So I figured like if I could hire him as an agent, then I'd be able to kind of pick his brain and learn how he got into it, which ultimately we can get into later, but that's ultimately how I got into larger deals. But he was my agent and he was an investor, so he had relationships and he actually knew the owner of the property. And the guy, him and his wife were moving to Israel for whatever reason. So he was offloading his whole portfolio here in Atlanta, and I checked out a couple of his properties, and then I found one definitely needed some work, but we got it off market. I was able to negotiate the price, and then I bought it using a home style loan, which is similar to like what a lot of people say the FHA 203K loan, where you can have a low down payment and get the funds in, including the mortgage to renovate the property, so you don't have to come out of pocket with it. Home style loan is very similar, except the home style loan doesn't have the requirement that you got to live there, and you end up getting a better mortgage insurance rate. Like you don't, it's more advantageous because it's conventional, whereas FHA is typically for people who don't qualify, don't have the credit score. If you got good credit, you can use a home style loan, put 5% down, and then get the renovation costs, including the mortgage. So that's exactly what I did, and I put up. I think we spent like 67,000 or so fixing it up. I think that's what I put into it, all in around 245, 250 ish, on the all in cost, and it's probably worth about 300 now.
Wow, that's phenomenal. Definitely a series of successive events. Now, for my audience though, they might not know what a syndication is, and they might, some of these people are new, they're getting started, or they're getting into the game. Could you explain to them what a syndication is?
Yeah, syndication is just a fancy word for group. So essentially, when you're buying real estate as a group, you typically will have two different parties. You have your general partners, which are the active operators that, like myself, where we're the ones doing the deal, we're sourcing the property, we're securing the financing, doing all the analysis, and then when we acquire it, we actually operate the property and then control when we sell, when we exit. And then you have limited partners who they're basically just investors. They put their capital into the project. They don't have any decision making rights. They're not the ones doing all of the work to manage it or find a deal. They just invest, and because they invest, they get equity in the project. So as the property improves, and you're able to increase the value, increase the cash flow, and then be able to exit, they get a piece of that of all of the cash flow. So it's just basically using teamwork, people coming together to be able to do a deal that maybe neither one of them or none of them will be able to do on their own.
Okay, yeah, I think that definitely answered that. And so you mentioned earlier how you said you had a duplex and then learned the process to scale to larger multifamilies. Is that what you described? Just describe the process, or is it something other than that?
I'm sorry, I just got to text somebody. my family got into an accident. But
Oh no, my
yeah,
condolences.
no, that should be fine. Um, Sorry about that. Um,
You
but yeah,
sure?
I'm sorry. Yeah, yeah, I'm good. I'm good. They'll let me know. But what were you saying?
Oh, okay. Yeah, I was saying that you mentioned earlier that there was a process from when you buy a duplex and then you scale into larger commercial multifamily. Did you already describe that process, or is it a different process from what you said syndication was?
Yeah, so that's a more generic process. It's essentially how I did it specifically, and this is you could potentially use it as like a blueprint for getting into it. But when you at real estate at this scale, everything's about teamwork. So you may not necessarily be skilled in everything, but you may be able to get good at one particular thing and then partner with people who are skilled in other things, the other skills that you need that complement yours, and you can come together and do a deal. So like for me, same time I was doing the duplex project and going through that whole process, I learned the whole process for analyzing and underwriting multifamily, and then learned the business in general, like how things work, the terminology, how to speak the language, all different components of it. And then I connected with other investors who were more experienced that were already doing deals. And then I essentially just added my skill set to what they were doing. And then for like almost 2 years was just underwriting deals, just going through the analysis, running the numbers on a lot of deals. We probably looked at like hundreds of deals over the course of that time frame. And then we actually closed on a deal, and I was able to get equity as a general partner in that project. So that's how I got into it, and that's, I would say, a good like kind of step or process for getting into or scaling up. One, you gotta have the knowledge. You gotta really understand what you're doing, be able to speak the language. Two is building relationships, especially with people that are more experienced than you, because you're gonna be new to it. And then three, just working with those people to be able to provide your skill set to combine it with theirs, and then you guys can actually be able to close deals.
Wow, that's some insight. Yeah, definitely. You guys make sure to take notes. If you're not taking notes, you definitely should be. Um, so now, how can I help you?
Mm. Uh, I guess one good way is, so outside of me doing real estate. So I already told you my whole plan of like my rationale for getting into real estate was to get into start doing business in Africa. So with that in mind, I actually launched a podcast this year with the co-host where we interview people that do business and entrepreneurship in Africa, as a way to build a community of investors, to build a community of business owners and entrepreneurs in Africa, so that when we're ready to do development and we start looking at those markets, we already got the relationships needed to be able to get some things done. And in general, we want to connect the diaspora. There's people in Africa that feel a disconnect between the Africans and diaspora. Just like yourself, you say you trace your roots back to Sierra Leone. You trace your roots back, you may not have a direct connection to people in Sierra Leone. So that's part of what the podcast is about. So always looking for new viewers. Always want people to get involved and engaged, see what we're doing. Feedback is always welcome. But essentially, we just want to be able to bridge the gap between the diaspora and people on the ground on the continent, and then think about how do we facilitate resource sharing across both ways, because there's a lot of things that as Black Americans, we have access to here versus like what we have access to in Africa. And if we could start combining things, we could really do a lot to benefit each other. So always looking to have people tune in and check us out.
Yeah, shout it out. Is it? What's the name of the podcast?
Oh yeah, I should say that. It's Afronomics. Afronomics is the name of the podcast. So think like Afro and then economics. So Afronomics, and the name, that's the name of the podcast. The platform, like our social media handles, Afronomics TV. The YouTube channel is Afronomics TV. Facebook, TikTok is Afronomics TV on all platforms.
Afronomics TV on all platforms. Awesome. Yeah, you guys make sure to go check that out. Like, subscribe, support the movement. Okay.
Yep.
How can you help me?
Now, my biggest thing is networking. Network. So I right now I do commercial real estate consulting. So of course I bought a couple of apartment complexes myself and operated them, still operate them, um, raised capital, have done everything in the acquisitions process, and now my focus is just helping facilitate others to be able to close deals in commercial. Mostly multifamily, but there's other opportunities. And a big way that I help is through connection and networking, and being able to attract dollars to projects. So I actually have a couple clients now. They're looking for just equity to be able to close their deals. So I'm working to facilitate transactions with private equity firms to be able to help them close the deals that they're working on. So that's one way I can help, and then everything else is like just going to be involved with acquisitions, due diligence, underwriting, market analysis, anything you need to do to be able to feel good about making an acquisition. That's where my expertise comes in.
Smooth. That's smooth. Okay. You might have already touched on this. Now, do you have a product course or coaching you want to promote to my audience? I mean, I know you just discussed, what you offer as far as your consulting is concerned, but other than that, product or a course that you wanted to promote.
Nah, I don't do products or courses. I just do real estate.
Anything you want to speak on?
Um, I appreciate you putting together. I know from experience, running podcasts isn't always as easy as it seems. But the conversations that can be had and the knowledge sharing is very important, especially when you're facilitating knowledge and insight within our community, because we don't talk to each other enough. I think unity has always been our biggest, or unity or lack thereof has always been our biggest issue, and it's important that we speak to each other constructively, be able to have constructive dialogue, and understand that we're more similar than we are different. And if we can figure out how to work together, then we can essentially do anything that we want and not have to fall victim to a lot of the traps that we're subjugated to right now. So that I just like being a part of that conversation. And if anybody else is interested in furthering that conversation, that's why we had the platform that we had, to be able to keep facilitating that conversation and yeah, just bringing us together.
That's wow. That's definitely, I would say, that's admirable. Definitely to be admired. Continuing the conversation, unity. Um, yeah, all great qualities. I did want to ask. You mentioned earlier where you said you've done a couple of syndication deals and closed on a couple of properties. How many units do you own currently?
Mm, it was 202, but we had a fire on one property and lost 8 units, so it's 194. Then I have another 68 units that I do asset management for, but that's third party. I don't own the property. I just operate it, do asset management on behalf of a client. And now I'm branching more into doing different things. Like through consulting, you have one of the things I like about it, you have the opportunity to touch on different projects. So I actually had a closing last month where the client is they're a church. They're doing a three-phase development. We closed on phase one, which is an adaptive reuse project. So they're converting a bank. This is like been a bank that was abandoned for a while, but they're converting into a medical wellness center with 5 tenants. They're going to provide medical services, all black tenants. And the whole project is to revitalize the historic black business district. So now, venturing into outside of just multifamily and housing, moving into different aspects of commercial. But a lot of the work that I do, a lot of the clientele that I have, they look like us, and they're very much like impact investment focus. So they're doing things in a way to be able to promote like ownership within our communities, promote economic empowerment, um, being able to build and transfer wealth, things of that nature. That's a lot of the focus.
Wow. Yeah. So you're saying that, just to reiterate, because you said a lot of good things. Um, the consulting project you're working on with the church is a three-phase development with people that
Hmm.
look like us, who are impact investors, and they're focused on, changing the community, creating systems that can be built upon, and building upon the transference of wealth.
Yep.
Wow.
Yep.
Wow, you guys. So you can really make a, you guys listening, you guys can make a real difference in the community. As you see Sita's doing here, working with churches, making impact investments. And could you explain what an impact investment is?
Yeah, for sure. So of course, like real estate is very much like a monetary gain type of endeavor for most people. Impact investment is when you specifically are looking to improve the community, and typically the more vulnerable people in the community. You can build a condo, you can build a high rise, and that's great. We do need those. We do need luxury housing, for people who are well off in society. But a lot of times, what's less sexy and often more of a struggle to make the economics work is going to be impact investing in opportunities that benefit the people who don't make that much money in the community, but are very much essential and just as essential as everybody else. So impact investing is just looking to do real estate in a way that caters to those people.
Wow. Okay. Yeah, that's phenomenal. I mean, that's definitely like more of a philanthropic bent, um, when it comes to real estate, which is like you said, is definitely needed. I mean, there's plenty of condos, but the people on the other end of the economic spectrum also need services as well.
Correct.
So, now you said you have a team, right? And you were general partner on your first project. What does your team look like today?
Yeah, so my team's still very small. It's really just me, and I have a VA, have an executive admin that she's out of the Philippines. She's been with me for like 2.5 years though, and she's solid. Then as outside of that, I have an intern that's been working with me this year. He's also pretty experienced too. He owns a few rental properties himself, has an MBA contract concentration in finance. So he's very, very, very good with like Excel and running the numbers on deals and stuff like that. And then outside of that, I'll bring in like contract help here and there, or partner with other people. But we still pretty much a small team. As I have shifted, I've moved into different aspects, through the entrepreneurship journey, different aspects of the business. And now my focus and where I think I landed, what ultimately I was trying to get to is now where I'm at, which is more of a focus on private equity and financing deals. So with us having more focus now and being able to have more repeatable work and more of a something that's process oriented, we can start to look at to expand and actually fill more long term roles. So that's the next stage. That's what we're looking at for 2025.
Wow, that's great. I mean, that's a great team. You said you have yourself, you have your VA, you have an intern, and then you work with contractors. So you guys listening, this is a great structure to build your team or to emulate for the deals that you're doing. Um, Now, when you mention private equity, again, my audience, they may not know
Yeah.
what private equity is. Would you explain that?
Yeah, private equity is just a fancy word for investor capital. Well, outside of like public offering. So like if anything is listed on the stock exchange, like that's a public offering. That's like when the companies have their IPO, initial public offering. That's when they call it going public, quote unquote. And at that point, anybody can buy that stock. Like anybody can go and buy Apple's stock. But private equity is specific into where it's not like publicly offered. It's more so like there's a relationship involved, and you have people that are investing. I mean, it's not going through that whole process of like a public offering. Typically, you're gonna be there's a few different ways to do it. So you have like a syndication where you have multiple ways you could do that. You could do like a 506B, 506C. You could do a Reg D, Reg A. There's a lot of different ways depending on how you want to structure it, and then it's gonna be regulated by the SEC, the Security and Exchange Commission. Um, so a lot of people just raise capital either from friends and family. They may raise capital or be one of those people that like do a lot of marketing. Like you see it on LinkedIn a lot. People will market their business, their whole real estate journey, and they're essentially pulling potential investors in, getting them into their email list, having further conversations, and then at some point when they have a deal, they'll get them to invest in the deal. A lot of multifamily investors will do that once they got the credibility, and then you have private equity firms where they don't even do like real estate. They don't operate real estate. They really just raise capital from investors, and then they place that capital into projects by partnering with other sponsors. That's where I build a lot of relationships with private equity firms. I build relationships with sponsors, and then I can facilitate introductions between the two.
Mm, mm, okay. Is a sponsor different from the private equity firm? I mean, it
Yes,
sounds.
a sponsor, and a general partner. So there's multiple words for the same thing: sponsor, general partner, operator, essentially, or developer. This the person who is doing the real estate deal. Like they actually will find the deal, will operate the deal. They're responsible. They will sign on the loan with the deal. But that's a sponsor.
Okay. Because my understanding was that when you're doing, correct me if I'm wrong, but when you're doing a commercial deal, you need a sponsor because the sponsor has to have the same net worth or greater than the cost of the project. Like let's say the project is 5 million, the sponsor has to have a $5 million net worth for the bank to approve the loan. Now, is that the case? Is that what a sponsor is, or is it not?
Yeah. So yeah, you're talking about net worth liquidity requirement. So yeah, let me make sure I explain this the right way. So the sponsor or the general partners, yes, you need to have a net worth between all of the partners that are signing on the loan. You need to have a net worth equal to or greater than the loan amount. It doesn't have to be the whole project amount because some of that is going to be taken up by equity, but the loan amount itself, you got to have the net worth, and then you have got to have liquidity. I want to say I think needs to be 10% of the loan amount. So that's the liquidity requirement. So net worth, of course, can be in assets. It can be an asset, a combination of assets and cash. But liquidity means your cash amount between all the people that sign the loan needs to be equal to 10% of the loan amount in most cases.
Okay. Um, are there any banks you want to shout out that do these types of loans? Because I'm not. I'm sure my audience may not know either. But if you go to, I don't know, your local credit union, is that where they could get a loan like this? Or
Oh man, financing is going to be very project specific. Whatever the best case is, there's a lot of different routes you can go about it. Debt is typically or relatively. I mean, debt is more so straightforward if you have the you meet those metrics like net worth, liquidity, and then the asset itself because they're gonna loan based off of the value of the asset, and if the value of the asset isn't there, they're not gonna loan it. But it's pretty straightforward once you meet those requirements. Equity is a lot more difficult and a lot more of an art to how you get it. But as far as like getting debt, there's a number of places you can get. Like most of the major commercial firms, Walker Dunlop, CBRE, Berkadia, Cushman Wakefield, all those major firms that typically vertically integrated. So they have a brokerage, they'll have a financing arm. They some of them even offer like consulting services or even offer property management services, but all of them have their own finance arms. So you can get debt through them. Um, Local banks are good for it's more a relationship. You might be able to get better terms. They're just not as big, so you might have a, a cap on how much funding you can get. A lot of times they'll partner with other financial institutions though if the amount you're looking for is a lot higher. But it's very good to build relationships with local banks. CDFIs are good. CDFIs are community development financial institutions, which are basically like banks, but they're specifically more so for impact investment type stuff. So, like if you're doing affordable housing or if there's any type of community development or economic development aspect to your project, CDFIs are a good source. You can typically get more flexible terms with them, or they may not be as stringent on the requirements that you need as an operator. So you want to build relationships with CDFIs. Then there's government funding. You can get bond financing. Depending, you may need to be a nonprofit or partner with a nonprofit. But you want to look at whatever your local development authority is. Like in Atlanta, you got Invest Atlanta. You got Atlanta Housing, and a few other organizations. If you're doing something around the Beltline, they may have some funding around the actual Beltline organization. So it's really just a matter of exploring all the different types of options because real estate, specifically when you get to commercial. And commercial, of course, means office, it means retail, hotel, but also means residential beyond 4 units. If you have 5 or more units of residential, then that is a commercial project. And when you get into commercial, you're no longer just buying a property, you're buying a business. So you got to look at it through that lens. And once you get to that scale, financing a project is going to be you're going to spend as much time financing the project as you are actually doing the project. It's just that's what it is. You get once you get to that scale, financing becomes a much bigger part of how you get the deal done. Like you spend a lot of time focusing on the money when you get to commercial.
I'm taking notes.
Yeah.
Yeah, you guys listening. I hope you're taking notes too, right? Because I mean, you can play it back, but still always take notes. Um, that's pretty phenomenal. Yeah, very insightful. It's gonna spend a lot of time financing when you're doing these building projects. So, let's touch on that 202 units. That's one property or
It's two,
multiple properties. It's two properties.
yeah, two bigger projects. One's 100 units or was 100 units. One is 102 units.
Okay, so walk us through from where you. I mean, you said you do analysis, right? You were analyzing the project, and then you're now the owner of the project, managing the project. What was that process like for you?
Yeah, so the 102 unit was the first one, and that one was through partnership. I connected with, but really it was a deal that it was 126 units in Arkansas. I was one of the general partners on it. We had a few general partners on it, but I just did all of the numbers and analysis for it. We ended up getting that project under contract, and then and didn't close. We weren't able to close on it, so the project fell through. But one of the lead sponsors from that project had another project, which was the 102 unit, and she brought me in to do all the numbers and analysis on that project because she didn't have anybody else, and we had a good relationship from the first project that fell through. So when I got on that one, of course, ran the numbers. That one was it was more challenging from a numbers perspective. Like I had to do some custom financial modeling. Like one thing they have in once you get into like that scale, you get investors that have what's called waterfalls, and it's basically just shows how the returns are broken down like at each level. Because you're gonna you have like what's called a promote. It's like we're getting into high finance, but you have like a promote structure where, say you sell the property and then you owe your investors $1 million. That's what they invested into your project, and for you to give them a return, you got to give them that 1 million plus half a million to get them to a certain return that you promised them. So you might have that structure to where once you give them that million, you give them that money back, then you give them a half a million, you meet the returns you told them you were going to get, and then if there's funds beyond that, now you as a general partner have a promote, meaning you get a bigger portion of the remaining funds. So say like the project actually gave y'all $2 million, you might give that first million to return their capital, give them that extra half a million as a return on their capital. So now they have an actual return. They've realized a gain, a financial gain. Now there's another half a million left to be able to distribute. You can give half of that to your investors. So now they got their half a million return and then another quarter million above and beyond what you promised them. And then you as a general partner are able to get that last quarter million for yourself. So it's a promote structure of how the funds are broken down, how the cash flow is broken down beyond a certain point. You're always going to prioritize the investor capital because they give it to you. They're giving you their money to grow. So you prioritize their returns. So you incentivize them to keep giving you funds. So for that, I had to create a custom waterfall, just like an Excel headache, where I had to build out like an Excel model that showed just how everything was distributed. It included a GP catch up with a clawback structure. Like it was very complex, just what I had to do. Um, but in doing that, that's really how I got equity in that first project. And to this day, I've never been to Virginia Beach. I've never even seen the property. But one of the sponsors on that deal, he lives in Virginia Beach. He found the property, got under contract and everything, and then we came in and did everything else to be able to close it.
That's great. That's great. That's a great. That's really a great example of teamwork because, like you said, you've never been to Virginia Beach. The guy found the deal. You did the analysis and created this Excel waterfall documentation. Somebody else brought you into the deal, even after a deal fell through. So for you guys listening, it sounds like there's a lot of people self organizing, right? They're just independently. Hey, I'm finding deals, and then I'm connecting with somebody who does analysis, or I'm connecting with somebody like Sita here, or somebody like this other person you mentioned. She brought you into the deal, so the guy finding deals is connecting with people who's finding people like Sita. So that's a really good example of teamwork just in place where everyone is operating independently, like self organizing. So you guys make sure to be a starter. Make sure to just take ownership of your business. As you said, you are buying a business, so take that ownership. Um, and I did want to ask, between you owning this duplex to now you're purchasing 102 units, what changed in your mindset from believing, okay, I can get 2 units, to now I'm just gonna buy 100 units? How did your mindset change?
Yeah, I'm trying to think what made. Well, I had learned about syndication before I bought the duplex, so I already knew going in that you can get into larger properties relatively quickly. And I say that, but that isn't always the best route. Sometimes it is good to just do it more conventional. It depends on like what you're doing it for, because you can get more cash flow going off of smaller projects and just scaling up, and then just kind of leveraging it. That my route is very unconventional, but it was specific because like I didn't care much about the cash flow initially. It was more so about how do I learn the skills so I can go overseas and do the same thing, or how do I learn finance so I can just really compete at the commercial and compete at this scale. So just just a word of caution that there is a lot of merit to going a more conventional route and building a portfolio and scaling up that way. You can do very well doing that. But the mindset shift, like I knew going in because I understood I had got put on the syndication. I think it was through a podcast. It might have been, something like this. It was, I think it was Bigger Pockets when I first learned about it, which is again why it's important that you have this platform and people are able to be exposed to these different ideas. Um, that was one thing. Then a couple other things I read Don Peebles' book, Peebles Principles. You know who Don Peebles is?
Yeah, a developer in Miami, like actually I think the largest black developer in America.
Yeah. He's the most prolific black developer in America. Um, he's out. He's actually out of DC. I think his first or one of his major projects, the Royal Palm Hotels in Miami. But yeah, his book. He was 26 when he closed on his first commercial project. Yeah, he made a lot more money. I was 26 when I closed on mine. He made a lot more money than I ever did on mine. But
Auto, my bad.
you good. But yeah, he started early with his first commercial project, and then I went through this commercial real estate program called Project Destined, um, which that also kind of exposed me to getting into bigger projects, and that's actually where I met one of my mentors. Uh, he was one of the administrators of the program at the time, and we still keep in touch, talk regularly. He's out of DC.
Well, that's phenomenal. You said this Project Destin, is that a school, or is that like a curriculum, or is that like a one time thing?
It's like it is a one time. It's like an educational program. It's changed a lot. I was in like one of the very first cohorts, but essentially, is the concept is teaching minority students how to develop commercial real estate or develop real estate in general, but usually at the commercial level. And then they also hook them up with internships and help them with job opportunities and stuff. But it's Black, Asian, Hispanic students. I think at college and high school as well. Because when I was coming through, and I wasn't even in school, I actually had graduated by the time they had this program. But my line brother, he was still in school because we were like 2 years apart. So this was like my first year out of college, and they went to do a presentation at Georgia Tech. My line brother was there, and he decided to sign for the program, and then he asked the guy who was running it if I could join. And it was ran by two of my frat brothers from other schools, so they were cool, let me come in even though I was out of school, and yeah, did that. This is like 2018, I want to say, and yeah, since then. That was just another opportunity or a little more exposure. I think I had already read. It was around the same time that I read Don People's book, but yeah, I really started looking at commercial um, a lot more seriously, like around that time, like that 2018, 2019 is when I looked at really started getting serious about getting into commercial real estate.
Okay. Okay, cool. So from that first deal to that, that first, not the first deal, but the first 100 units to the second 100 units, was it a smoother process? Did you feel like it was better, or was it just a completely different experience?
It was different because the second one was affordable housing. It's LIHTC, which now you're getting into a lot of government regulation and compliance, which adds a whole other layer of complexity and headache and your red tape like that. That one took forever to close because the government essentially was like, nah, you can't buy this property until you do XYZ. So there was a lot more, and then I was a lot more involved in that one. Like the first one was mostly just like running the numbers and of course some complex financial modeling, a little bit of market analysis, a little bit of strategy and business plan development. But the second one, it was like damn near being one of the lead sponsors, like everything in the acquisitions process I was involved in. And then we also submitted a LIHTC application, which was a process, and then actually taking over, running due diligence, Like it was a lot more involved. So the stuff that I did on the first project, I was good with that. But now it's like there's all these other things that now I have to do for the second project. But now I'm good with those. So it's like every project you just end up. I That's been one thing I guess has been a challenge. Nothing that I've done has been like repeatable. That's why I was saying like I'm just not getting to a place where I feel like we will have a more consistent workflow and consistent deliverable with projects because we're focusing in on that private equity and like the financing piece. But since then, every project that I've worked on has been like just different. So it's like every single one has its own very significant learning curve that I got to figure out.
Wow. Okay. I mean that's a challenge, but I mean obviously you found success with it, so you're doing the right thing. I mean I can't tell you that you're not. So you're overcoming the challenges. So for my people listening, what does LITEC? What is LITEC?
Low income housing tax credit is just one way that they create affordable housing.
Mm-hmm.
Yeah. So, like everybody's familiar with Section 8 housing, where the government is going to pay a portion or all of a tenant's rent using like the housing vouchers. LIHTC is Section 42. It's just another way of creating affordable housing, but instead of at the tenant level, you subsidize the entire development or redevelopment of a property. So the tenants may have vouchers still in some units, but more so the rent on the unit is going to be restricted for a certain period of time. So it's like 15, 30 years. There's a 15 years compliance period and then another 15 year extended use period. So for 30 years, once a project is developed or redeveloped, the rents are going to be rent restricted as certain AMI. So the tenant may be paying the full rent themselves, but the rent may be like half what market rate rent is. So that's how LIHTC works. That's the thing.
Wow. So you guys, if you guys, this is something you guys are interested in, definitely make sure to reach out to Sita. I've never heard of this LITEC before, so he's teaching me the same way he's teaching you. Um, and then if you guys don't know, Section 8 housing it's government subsidized housing, so you'll get a housing voucher that will pay for either all of or a portion of the tenant's rent or your rent, um, whichever side of the fence you're on. And okay, so you said you've got the 100 unit. Did you got the 102 unit? Did you sell the duplex or do you still got the duplex?
Still got it.
Still got the duplex. Nice. And then you said you're also doing some asset management as well.
Yeah, just for one client. I'm not gonna do that no more. Yeah, I'm not
Okay.
picking up no more asset management clients.
Okay. Okay. So do you have any well, I'm sure you do, but what are your goals currently?
Yeah, so I actually need to document those, but it goes for 2025. Uh, Really focus around just the private equity aspect. Um, Looking to the goals to be able to support 300 million in acquisitions in 2025. Um, Clients right now I have like the development project. That one's $30 million project. Phase one was 6 million, so there's a good amount of work still to be done on the phase two and three. There's the other two clients I'm working with on the private equity side. Their projects total about how much is I think maybe one is 30 million. The other one is a $13 million project, and then there's some clients that I've been working with. We haven't been able to come together on anything yet, but they look at projects like 100 million and up. Like they do very big deals. So hoping to be able to get in a project with them in 2025 and really build that relationship to be able to do more work because there's some people at scale. It's just the way the market's been, everything's been slow transactionally, so it hasn't been. So like a lot of my clients that I probably could be doing deals with, they're not doing deals at all right now. So as interest rates are starting to level out. There's less uncertainty in the market. We're anticipating or praying for more transaction volume in 2025 and beyond. If we see more movement, then that'll be very good for me and my business, because we can, anything with acquisitions, anything with, attracting capital, raising capital, sourcing capital, is going to be very transaction based. You got to be closing deals to be able to do well. So my business is dependent on that. So that's what we're looking forward to in 2025 for that activity to pick up.
And now you have the 100 units and the 102 units. What's the size of your portfolio, like in dollar amounts? Would you say that is?
The 102 unit it was appraised at 17 million. We bought it like 16 something, 16 and a half million, somewhere in the ballpark. But it appraised at like 17 too. Then the 100 unit, because it's affordable housing, it's rent restricted. And as I mentioned, you're buying a business, and every business is going to be valued based on the income it makes. So because it's rent restricted, the income is lower. So it's only valued at like, we bought it at 6.5 million. So it was like 65,000 a unit, which is very low. But that's about where that lands. And of course, the 102 unit at 17 million is a little over, or a little under 170,000 the door. So you
Wow,
see
very
how
big
cheap
difference.
that is. Yeah, you see how cheap that is compared to the other one. And I mean, Atlanta's actually a stronger market than Virginia Beach. Well, turns depends on how you say stronger, but the rent restriction is why its value so low. So total portfolio between those two projects like 23 million.
Okay. When you say now when you say stronger market, what does that mean? Because my audience, they don't know anything. But
Yeah, so I mean, yeah, so I was saying initially stronger market, more so like a more in demand market.
mhm,
There's more population growth, employment numbers are better. The challenge with Atlanta and a lot of Sunbelt markets is the supply side, like construction. We've hit record years back to back in like construction. So new housing coming online, and of course supply and demand characteristics, basic economic principles. When you have increased supply, it's gonna drive prices down with demand being consistent. So population is growing in the Sun Belt as people are moving from like California, people moving from New York and some places up north. But at the same time, people are building so much housing here and have been the past couple of years that the housing units coming online is outpacing the population growth. So that's leading to rents being flat or even declining in some areas, especially if it's like a class A, the higher class luxury. You're seeing rents drop in those markets because there's just a lot more supply. But that is leveling off. The construction starts, the construction pipeline indicate that we're going to see less construction, less supply coming online, probably starting back half of 2025 and then into 2026, 2027. You'll see supply dwindling. You're not going to have as much coming online. But population is still growing. Jobs growth is still relatively strong. So you're going to start seeing upward pressure on rents again, probably back half 2025, going into 2026. You're going to start seeing rents start to go up a little bit again. Still shouldn't be too crazy, but you'll start seeing that those rent increases, and then multifamily valuations will start to go up a little bit. But we're not going to see what we saw prior to 2022. That's probably not going to happen again no time soon. It was the perfect storm of everything for multifamily. Following the great financial crisis, a lot of we didn't build. The great financial crisis, the housing market, the bottom fell out of it. Prices were very low. You could buy houses for like a song. Like you could just buy property mad cheap, and we weren't building, which ultimately contributed very heavily to the housing shortage that we have nationwide. Because from 2008 up until like I don't know how long, like a decade, we just weren't building housing. and population was growing, but we weren't building housing, which led to this huge supply shortage in terms of housing, which they started to correct for. And then like the past few years, that's why you've seen a whole bunch of construction. So with the housing that was increased, the housing shortage coupled with record low interest rates, we had interest rates as low as like 2.5%, 3%. Like that's, you don't see that. Like that's incredibly rare. Back in like with the 80s, 90s, rates were like 12, 13%. And people got used to that. Then they started dropping late rates to 2, 3% in the like early 2020s, or like 2019, 2020, 2021. You start seeing these incredibly low. We're not going to see rates that low with such a shortage of housing. That combination, we're probably not going to see that again in our lifetime. But that combination meant that anybody who bought an apartment complex was gonna make money damn near. Like you had to really, really, really be bad at what you're doing to lose money in that market, because you kept seeing cap rate compression, and cap rate is just it's a ratio. It's the ratio between property's net operating income and the value or its purchase price. But typically, when cap rates go down, prices go up. When cap rates go up, properties go like the sale price of your property goes down. So if cap rates continuously going down, you could buy a property, the cap rates will go down, and you can sell it for more than what you bought it for. That was typically the case, whether you operated it well or not. You had people that bought properties that were losing money every month and were still able to sell the property for more than what they bought it, even though the property is supposed to be valued based on the amount of money it makes. So that's all that to say, that was a special time. It's not going to happen again. Now, if you want to be in multifamily, if you want to be in commercial real estate, you got to really know what the hell you're doing and how to operate. The margins were tight before. Now they're paper thin. Expenses have gone up. Insurance has gone up. Payroll, wages, your staffing costs has gone up. Construction costs went up after COVID. Everything, labor, your timber, like materials, everything you need for construction went up. So now your expenses are higher. And then, as I mentioned before, rents are flat. Rents have been flat or decreasing. So now you're in a place where your bottom line is a lot tighter. You got expenses going up while revenue's going down. So now your margins are paper thin, and it's very hard to make a deal work. You got to really know how to operate well to be able to perform in this environment. And that's going to be moving forward. That's going to be for the next few years, at least until things level out. You're going to get a little more breathing room, but it's still going to be a lot more difficult to be successful in this business at this scale than it was 4 or 5 years ago.
Wow, you're definitely a wealth of knowledge. I mean, it sounds like you've already got this forecasted. Well, I mean, that sounds like you're saying you've already got this forecasted, 2, 3 years in the future. So that is, for all you guys listening, this man with a plan. I mean, he's 3 years in the future. So make sure that you guys are doing the same, for your own financial future, for your own investment portfolio. Um, so man, that's been a really good interview. We're getting right up here to time. Um, Definitely, guys, make sure to reach out to Sita if you need him for any of your consulting. Definitely, I mean, obviously, you're not going to get any worse than what you heard here. So, you know, this was very educational. So make sure to reach out to him if you guys need him. Um, as you can see, he's making major successes in the real estate industry. Um, any other books you want to recommend?
Um, yeah, books, specifically for real estate business.
Whichever.
Um, uh, let me pull up my book list. I have several. Never Eat Alone is a good one. A book on networking. It's just very good about, network is actually incredibly important. Uh, Damn near more important than actually being good at what you do. But Never Eat Alone is good, but for networking. For the Disciplines of Execution, a very good book. Just like how do you actually put together a structure within your business and your team to accomplish goals, even when things happen in every business as they often do. Of course, People's Principles, another, like I mentioned earlier, definitely a great book for commercial real estate. The Wealth Choice is very good. Have you ever heard of Think and Grow Rich by Napoleon Hill? The Wealth Choice is like similar, but specifically like for Black people. I think that's a great book to listen to or to read. Outwitting the Devil is a good one by Napoleon Hill. And Atomic Habits is one of my favorite books. Atomic Habits is one of my go tos. I read it once physically and listened to the audiobook again recently. It's just basically how do you set up habits in a way that make you successful, because everybody looks at big decisions as the important decisions, like where you go to school, what fields you get into, who you marry. Those are important decisions, but the most important decisions are actually the small decisions, the ones you make every day. Because over the course of years, those small habits add up to massive change. And Atomic Habits just kind of gives that breakdown of how you set those habits up for yourself. So those are the ones I'm gonna leave you with.
Awesome. So, all right, guys. I hope you took some notes. I definitely took some notes. Um, make sure to tap in with Sita. Um, subscribe to the channel. Like the video. Share this video with 3 of your friends, family members going through the same situation, or if this is relevant for them. Um, and we'll see you on the next one. All right.